The S&P 500 just broke through its 200-day moving average, one of the most important technical resistance levels. Investors are cheering the temporary trade deal between the US and China that are opening up to a broader agreement. But while the long-term uptrend in the stock market seems like it could be continuing, consumer sentiment data is painting a very different picture. This line here shows us how the average American feels about the future of the economy. People are feeling more pessimistic today than at the heart of the great financial crisis in 2008. This shows us a deep disconnection between the market's current optimism and the public's mood, and it begs to ask the question whether stocks can actually continue a bull market despite sentiment being this low. This survey is the University of Michigan's Consumer Confidence Index, and it shows us how consumers view the future of their own financial situation, as well as their short and longer-term outlooks on the economy. The latest reading of the index came in at 52, one of the lowest in recorded history. We've seen the index dip only 5 times below 60 in the 1973 and 1980s recessions, the global financial crisis, and June 2022. In fact, when we invert the US Consumer Confidence Index and overlay the unemployment rate, we see that consumer confidence often leads the unemployment rate, so it's been a very reliable indicator of economic recessions throughout history. This was the case in 2020, the global financial crisis in 2008, the dot-com bubble in 2001, and all of the recessions going back to 1953. This makes sense. Consumer sentiment is an incredibly important part of the economy. Healthy consumer sentiment promotes spending, leading to strong economic growth and so a strong job market. When consumer sentiment turns sour like today, it often means that people are pulling back on their spending, which can lead to lower economic growth and hence a weaker job market. This is one of the big risks in today's macroeconomic backdrop. If this chain reaction begins to take place, layoffs could spell trouble for the stock market. But right now, we don't have concrete evidence that this is actually happening. Today, job growth has been quite resilient. When we look at the non-farm payroll data, for example, we see 167,000 jobs were added in the month of April. In fact, we've seen job growth stay above 100,000 per month pretty steadily despite all of the uncertainty around tariffs and the very weak consumer sentiment. If we look at what job growth looked like in the lead up to the last few recessions, we see that it frequently dips below 100,000 as the job market is gradually deteriorating, heading into an economic downturn, before eventually even dipping below zero, suggesting that layoffs are happening. This is quite a different picture to the one that we have today. So in the absence of an economic recession, we actually happen to think the low consumer sentiment reading could be a constructive reading for the stock market. Because believe it or not, these extremely low readings in consumer sentiment were actually exceptional buying opportunities for the stock market looking out 12 months. We can see that more clearly by adding the S&P 500 on top. Low consumer sentiment readings often correspond to bottoms in stocks. In the 7 instances that the sentiment index dipped below 60, the average S&P 500 return in the 12 months that followed was roughly 20%. As you can see, there is one big exception, however, and that is June of 2008, where the stock market declined by another 28% in the year following a very poor consumer sentiment reading. When we look at exactly what this episode looked like, we see that consumer sentiment plummeted below 60 right here in June 2008, and at the same time the stock market was making a brief bounce. This was then followed by much more pain in the months that followed. So it is a fair question to ask whether we're currently in a similar situation to June of 2008. Well, zooming in, we see that the S&P 500 actually tested its 200-day moving average in June of 2008 at the same time as the low consumer sentiment reading. But price failed to break above it and reversed lower, showing weakness in the price action. From a fundamental standpoint, S&P 500 earnings had already declined by 24% in the first 6 months of 2008. There was already a deeper structural downturn taking place. This was not just a temporary panic. If we fast forward to today, the setup does look very different. The S&P 500 has been able to recover back above its 200-day moving average, showing us quite incredible strength. Now, in the short term, the market has gotten a little bit overextended, and we think it is vulnerable to a pullback. In fact, we sent out sell alerts to our clients at Bravos Research for quite a few of our trades earlier this week. If you want to have updates like that, by the way, make sure you're subscribed to our membership. But overall, this strength is extremely constructive and very different to the weakness that the market experienced in June 2008. And when we look at the S&P 500's earnings, we see they've generally been trending higher over the last couple of quarters, not really showing us the same structural decline that we had at the beginning of 2008. Arguably, we could see S&P 500 earnings get pushed even higher over the coming months. The current US administration expects China to remove non-tariff trade barriers that have been in place against American goods and businesses on top of reducing tariffs. Keep in mind that the S&P 500's exposure to China has grown quite substantially over the last couple of decades. A removal of non-tariff barriers in China could provide a tailwind to S&P 500 earnings as companies will be able to expand their business operations in China. So both from a fundamental and price action standpoint, the stock market looks better today than it did in 2008, which gives it, in our opinion, more favorable odds to continue moving higher heading into the end of the year, even if in the short run it could be vulnerable to some consolidation and digestion after the huge rally that we've seen. Our golden principle at Bravos Research is that we invest when volatility is high, when there is blood on the streets, and we trade when volatility is low and the market structure is strong. We have very quickly gone from an environment where we are recommending that our clients invest in stocks for the long run to now an environment that is much more favorable to trade more actively. This means we're currently ramping up the number of trades that we have on the website. So far, just in the second quarter of 2025, we've closed 17 trades, averaging a massive 27.5% profit each, and that's with only about 11 losses, averaging a 7% loss. That's a significant outperformance relative to the S&P 500 that has been pretty much flat over the course of the second quarter of 2025. We use a combination of macro, technical, and intermarket analysis to guide our decision making. We show you exactly how and why we are implementing our strategy and trades step by step on our website. If you're interested in a service like this, I strongly recommend you go to our website and give it a try. Thank you for watching.